Good afternoon, everybody, and welcome to the weekly LendIt Fintech News Roundup. My name is Peter Renton, Chairman and Co-founder of LendIt Fintech, and I'm here joined today by my good friend and colleague, Todd Anderson. How are you doing, Todd?
Good, Peter. How are you?
Great. And we're also joined by Lindsay Davis. How are you, Lindsay?
Doing well. How are you, gentlemen?
Great.
Doing good. Welcome.
Yes, welcome. So before we get going, Lindsay, why don't you just give us 30 seconds and introduce yourself for the audience?
Yeah. Hey, everyone. I'm Lindsay Davis. I'm head of markets at Atomic. We're a startup building payroll connectivity to help consumers access the financial data in their payroll accounts and make payments out of their direct deposit. Prior to that, I was the senior fintech analyst at CV Insights, where I led some of the quarterly fintech reports and categories around neobanking and some of the top topics of the news that we're going to be drilling into today.
Okay, well, let's get right into it. So the first topic, this actually came out last Friday, but I feel like we need to cover it today because it's a big deal. Chime raised $750 million at a $25 billion valuation. Really, they continue to execute. They're at 20 million customers now, is what they say. And I think Chime, they just continue to grow extremely rapidly. No one would have thought they'd be at 20 million when they were just barely at 1 million just a couple of years ago. So it's been quite the meteoric rise for them. And now they are the clear digital banking leader in this country. No one else is close as far as number of customers goes. And now we'll see if they can turn that into a sustainable business. What do you guys think?
Well, it's a boatload of money. I'm kind of like of two different minds on Chime and some of the money going in, like Revolut as well. It's clearly there's a ton of customers that have gone, but how many of those customers are getting their weekly or bi-weekly or however they get their paychecks into Chime? Are they just using Chime as a secondary account? A lot of the account balances on Chime are still pretty low, or average balance, I believe, are still pretty low. Mm-hmm. 20 million customers is I think a generous number, but they're clearly the leader in at least that paycheck to paycheck crowd, and have brought a lot of people into the system. I just don't know what the lifetime value of a customer who goes to Chime really is.
Mm-hmm. Yeah, I'm just add on. I felt like it was a perfect segue. Payroll connectivity broadly can help neobanks get that direct deposit and makes that a streamlined user experience for neobanks in the market. And we work with several of them, but not staying on Atomic, rather thinking about what Chime has enabled. You've got 20 million consumers that are actively looking at Chime because their core banking product isn't doing it for them. If you think of what has happened in 2019 to 2020, we saw 11.7 billion in 2019 in terms of overdraft fees collected against consumers. And though there were moratoriums in place, like that got worse. If you look at the top, big bulge bracket banks, they collected 4 billion last year. So there's still a problem. So in terms of, the money and the growth, like there's a clear need, and they're solving components of that for this, target demographic. It's just literally access to a bank account that doesn't charge them fees. It's not novel because we've seen several neobanks now crop up across different, target pain points, but it is table stakes in fintech. Yet banks refuse, mostly the large ones, to move even down on the fees. Like 35 is such an arbitrary number. Don't you agree?
Right. Yes, indeed. And that's one of my favorite topics is discussing the overdraft fees and how they're such a ridiculous product, and they actually should cease to exist. I'm hoping they're going to cease to exist because all of the world will move away from banks that are charging overdraft fees, and they will be.
It's something I hope to see as well, Peter. It's something I was extremely passionate about at CV Insights, and even more so now today. And I don't know if you two caught the news because you were prepping for the show. The office of Governor Cuomo's office released a statement regarding overdraft fees and capping the level that New York banks are going to be able to charge. So I'm really, really excited to see that happen. But
interesting. No, I didn't see that.
Very interesting here.
Yeah,
I think the bigger long-term question is the smaller banks that make such a profit on overdraft fees. When that revenue and that money goes away, can they find a way to find different sources to supplement that, or is there a mass consolidation amongst small community banks, or do the big banks just keep scooping up different?
Well, I think, if they're not thinking about it right now, they have their head in the sand, because the movement, if you're relying on most of your profits from overdraft fees, your days are numbered, and you need to go and think about other revenue streams. But anyway, let's move on. I want to talk about the study that came out of the University of Texas earlier this week. This was basically a study on the PPP loan data, where they claimed that 40% of fintech loans were questionable. And they did this. I said on LinkedIn, this study is an abomination. It was such a poorly done study, one of the worst academic studies I've ever seen, because they didn't do any research, really. They analyzed numbers, and they analyzed numbers that were incomplete, because they actually, when they went back and these companies were looking at the data, they said, well, half the loans they said are questionable, we never actually made. So we thought they were questionable as well, so we didn't make them, but they got included in the study. And I talked with Phil Goldfeder of Cross River Bank about it. He was furious that they didn't speak to him. They didn't give them a chance to actually correct the record. And I feel like it was just done to create headlines. It did that. Now everyone thinks, fintech's useless. They just do bad loans in fintech, rather than, of course there was going to be fraud. There's, $300 or $700 billion going out the door. There's going to be some fraud. But to say that 40% of fintech loans were potentially fraudulent, that is, I hate to say, absolute bullshit.
I think,
gentlemen, I must tell you, I saw that as the headline, and I didn't even waste my time with the study. I was like, garbage data in, garbage data out. Like, that was my point. And I'm glad that you brought in Cross River, because they were a leader in the space in terms of their ability to facilitate the movement of the money just to the end borrowers that needed it the most. Square as well. There were a lot of things that went well with the SBA program, and I would have liked to have seen that being highlighted.
Yeah.
Congress made the bet. Getting money out the door was a higher priority than making sure each loan was perfectly underwritten. They made the bet and said, get the money out the door. We don't care, essentially, at this moment. Yeah, maybe we'll care about some of the fraud down the line, but just get it out the door, save the small business, save jobs. We'll deal with some of the after effects later. And then the bank said, well, we're not going to take that risk anyway. We'll just serve our own customers. And in that, we'll serve our highest of high own customers that we know the best. And we'll leave fintechs with the quote unquote scraps that we're not going to want to serve. And fintechs helped all these businesses. And yeah, there's some fraud there, but percentage wise and what really happened, so many more jobs were saved than fraud
I really
dollars.
think if fintech wasn't involved, this was just left to the banks, and there was no fintech involvement on this, you would have seen unemployment 2, 3, 4 percentage points higher. I'm convinced GDP would have crashed even further, because you would have had hundreds of thousands of businesses just disappear because they couldn't get the money because their bank wouldn't lend it to them. And keep in mind, the early days of the crisis, a lot of companies' revenue went to zero. And it went to zero for weeks, and most companies only have like 30 days of cash on hand. So you imagine if it took 60, 90 days for these businesses to get cash, they'd be out of business. And that's where fintech stepped in and said, we can do this. We can do it quickly. We can do it effectively. And they did. And I'm not pretending there was no fraud. And there maybe fintech might have had more, or probably did have more fraud than the banks, because the banks only loaned money for the most part to their existing customer base. And so if you're lending money to your existing customer base, there's going to be less fraud. You have a lot of information, but they wanted these small companies whose banks wouldn't talk to them. They looked for alternatives. They found fintech and they got the money. And I would expect fintech's fraud rate to be higher. 40%. You've got to be kidding me. That's just ridiculous. So
I would like to double click on one thing that we didn't talk about here, which is that the government stepped in and made these programs happen, and they moved the money faster. And that's a lesson learned from the financial crisis, which of course the genesis of modern fintech, and what were the first businesses out of the crisis? Lending businesses. So it's something to be said, like, we've learned a lesson, and like, what are the lessons that we can learn from this crisis? And some of it has to do with the application process and the ability to streamline portals for, banks to even take the applicants for the so to speak scraps. But that the technology, if it wasn't in place, like the banks that really wanted to get in the game couldn't. So that's something to take to the next crisis.
Yeah,
and we've got a story coming down the line.
So, totally agree. I mean, if this had happened even 5 years ago, it would have been a very different situation because the technology wasn't going to be there. 10 years ago, it would have been so much worse because the fintech companies didn't exist. The Congress would have said we need to implement it, and the banks would have said can't do it, not possible. And that would have been a total disaster. So anyway, let's move on. I could talk the whole 30 minutes about this, but I'm not going to. So speaking of big banks, and we had what was really interesting. Jamie Dimon, the CEO of the largest bank in this country, said in January on his earnings call that he called out Plaid and said, these guys are not using data properly. Now you go back August, and Jamie Dimon is investing in Plaid, even though they say they've done a change of heart here, and they had, like, Plaid had announced their $425 million Series D. I think it was a couple of months ago now, and they've extended it to include JP Morgan. So Jamie Dimon has again had to change his tone, it seems like, with and as Zach said, one of the articles I read, Zach Perret, the CEO of Plaid, said that they've had a relationship with JP Morgan for a long time. And it's not like this is new. And even when Jamie Dimon said that, they had a relationship with Plaid. So.
A complicated relationship.
Yes, indeed.
I mean, this is, it's more evidence that data sharing, open banking type is becoming more and more the norm in the U.S. while it's not regulated to the point it is in Europe and the U.K. Banks know that doing it and working with different partners like Plaid is a lot better than the whole screen scraping. And I think we're going to see just more and more of data aggregation and doing it safer, doing it better. And eventually, I think open banking might get to the point of a regulated thing in the U.S. I don't think in the near term. I saw the OCC put out the executive order, a thing about open banking, but it's big banks are moving on the path with data aggregation.
Well, I'm going to tighten that a little bit for you. So the executive order was released by Biden's office, but actually following that, the OCC, the FDIC, and the SEC combined forces to put out risk mitigation frameworks for the banks. So the executive order gives consumers the ability to port their banking data and to create, a more transparent system for them to move and stir up some competition. Now, on the back end of that, the regulators say you need to have third-party risk management frameworks in place if you're going to be using any kind of data, aggregation service of any sorts. So it's kind of like ammunition for the banks to go back to the third parties and say, like, if you don't maintain, direct API connectivity, we're not going to be as understanding when you're screen scraping us, and i.e. we'll cut your access, and that in turn creates consumer friction because then their accounts are disconnected from the bank account. So it's a move in that direction, but it's not enough of a stick. Like, we actually have an open banking framework in Europe where there's fintech companies that have thrived as a result of it. We're moving hopefully towards that. Like, I'm optimistic that the executive order opens up the door, and it does literally calls out the CFPB's ability to define what is financial data and how should consumers be able to access it. So there's more to come. We wrote a letter in terms of including payroll data in that, because payroll, we believe, is the source of financial data for so many different products, including, for underwriting loans, qualifying someone if they're employed or not, but more to come. Right now it's just banking data, but.
Yep. Totally agree. So let's move on. This was an interesting one. Visa is rolling out a buy now, pay later product. And this is, I mean, if we go back to our Europe 2019 event, Todd, you remember that we had a keynote presentation from a Visa executive.
Chetan.
Yes, Chetan. And he was now working, I think, at Bluevine. Anyway, Fundbox, can't remember which one. But anyway, he introduced this product, and it was only available. It started in Poland, of all places, and he introduced this product, and it's been going in Europe now for a while. But I've wondered why it has not come here. But now It has, and they're partnering with I2C. Basically, I mean, this is a no-brainer to me. People love buy now, pay later because of just split it in installments, becomes more manageable. No interest charges. People don't like paying interest, and so Visa has had the ability, like companies like Afterpay, when they are when companies sort of putting with Afterpay, that's bypassing the Visa network, and that's this is something that I think they've obviously had their eye on for a long time, and now they basically say that any Visa cardholder eventually will be able to split any of their charges over time, and any merchant will be able to offer a Visa basically installment buy now pay later offering. So it's just rolling out now. It's going to be very interesting to see how it actually whether it gets traction, whether this impacts the Klarnas and Affirms and Afterpays of the world. But it's an interesting development.
Yeah, I would just add to that. Not only are they trying to skirt the Visa rails, but they're also trying to skirt the fees. So for merchants, it's interesting to see what the bottom line is for them, because a lot of merchants are paying. They're trying to get around paying, the credit card fees by putting minimums on the amounts that you can charge. Giving different types of incentives. So we'll see. Visa's clever. They're not going to be cut out of the stack anytime soon.
Yeah, and they're also one of the most valuable financial services companies on the planet, and they still ain't. I can't remember how many $1 trillion last year it was, but it was several trillion of transactions that they did, and that's things can change fast. And I think that you look at Afterpay and how Afterpay now 15% of all apparel in Australia goes through Afterpay. 15%. That was most of that would have gone on that would have been all credit cards pretty much, just probably 5 or 6 years ago. Now they've already hit 15%. And so that's not going on Visa rails.
Even the psychology of the 4 payments makes you think you're paying less in a way. Like when you're at the checkout, it's like $200 or $50 over a few payments. It's like, all right, I have $150 more right now. It's that, the psychology of that and the thinking behind making the purchase it's only beneficial to the merchants and a no-brainer, like you said, for Visa.
Yeah. Okay, so moving into crypto, kind of. Walmart. Yes, Walmart. They're actually hiring seems like a fairly senior person to develop their digital currency strategy and product roadmaps. So Walmart, and it's funny that Amazon had this almost the exact same position advertised a few weeks ago. But so these the biggest companies in the country are really trying to figure out what they're going to do with digital currency, and they are looking at they've got a massive customer base. So what moves they make is going to be a really big deal for crypto for sure.
Well, it's also recognition. I mean, they have such a broad base of consumers. Their willingness to try a new technology and to enable it in some fashion, either from a consumer perspective or a merchant perspective. I mean, it shows, we're thinking ahead in the sense where we know this thing is here and we cannot, not be included in the narrative, because then we will be made obscure. And so for them, it's probably a move to future hedge against that, to have the team in place. Have the team in place when you want it, not when you need it. So I'm excited for them and their broader fintech strategy, which has evolved over the year. I'm looking forward to seeing it.
To me, this is the question: what happens with digital currencies? So you have CBDCs, you have all this stuff going on. It's clearly the future. How and when and how fast, I don't know. But if a retailer like Walmart is getting involved, soon you'll probably see Target, you'll see others begin to think of similar strategies, and it's just going to keep going and going and going. And accidentally we're going to turn around and it's going to be mainstream. We're going to be using crypto to pay for things, and I think stuff like this that makes me think, while I've been a skeptic in some ways, think it's going to get there quicker when companies like Walmart begin to get involved versus a lot of the startups that have been focused on crypto for a while now.
Right. What I'm curious about is if this going to be part of Omer Ismail's group, the former head of Marcus, who moved to Walmart back in February, I think it was. Been very quiet there for the last 6 months. I'm just wondering if this is going to be part of his
Something's coming.
his purview, because I mean, they as you said, as we've talked about before, Omer Ismail didn't go from being the head of Marcus, where he was a partner at Goldman Sachs, go to Walmart for something that was just duplicating what he was doing at Goldman Sachs. It's going to be bigger. It's going to be different. This could well be part of that.
I feel like this is going to be a horizontal role. So we'll see it play out across different lines of business. So perhaps the consumer side of things, but also the financing side of things. Yeah, it's got broad applications. Why not try? And that's going to be on this person. 10 years of experience, a little bit tricky, but
10 years of crypto experience would be true. 10 years of product management experience would not be. So,
right.
That's there'll be plenty of people out there with 3 or 4 years of crypto under their belt. Anyway, let's move on. Wanted to talk about Aspiration, another digital bank doing quite well. They really sort of taken on the green finance mantle. They're all about the trying to combat climate change in everything they do. Anyway, they announced, this was rumored like a week or two ago, and now it's official. There is a SPAC deal in the works, $2.3 billion valuation. It's going to raise like $400 million. And I think it's interesting that the revenue, this is revenue for Aspiration 2020, 14.7 million, not a very sizable organization. 2021, apparently they're on track for 98. So 14.7 million to 98 million. That gives you an indication of how they're growing.
I mean, sustainable finance it's gaining more traction. It felt like 2 years ago it was ready to take off, and it felt like it's plateaued a bit. I know the pandemic has probably thrown things for a loop a bit in terms of what people care about, if they're more and totally focused on figuring out where their next paycheck is. Maybe if they've had, the pandemic doesn't hit and really kill jobs for a little while, but I feel like the company it's doing good things, but it hasn't, with some of the other digital banks keep taking off. It's been kind of more of that slow, steady growth for Aspiration.
I think we could see substantial growth in the category broadly. If you look at flows into just ETFs for ESG or sustainable related funds, it was 51 billion for 2020. So during the pandemic, it actually increased, and it ended up being, a safe haven for investors because it weathered the financial sort of volatility in the beginning of the storm. And the environmental crisis is very real. If you just look at the price of coffee, beans are set to increase 40% as a result of climate change.
Yeah, and I think climate change is, this year with all the wildfires and hurricanes and floods and everything else that we've experienced, I think my feeling is that sustainable finance is about to just totally take off. And I think Aspiration is going to be a beneficiary of that. Okay, so want to talk about a funny story. I think it's funny anyway, from Wells Fargo. Wells Fargo, we talked about this on the show a few weeks ago when they announced that they were shutting down personal lines of credit, gave their entire customer base 60 days to pay up, or it's going to be converted into a term loan. And then consequently, the credit utilization of all of their customer base was going to be altered, and their credit score was likely going to go down. And that people were not happy. Had Senator Elizabeth Warren railing against Wells Fargo on Capitol Hill, as there should not be one person whose credit score goes down because Wells Fargo happened to want to get out of a new business. So anyway, after the public outcry, they're no longer shutting down their personal line of credit business. Really, the PR people at Wells Fargo are crushing it, aren't they? It's like, anyway, they're now giving people, they're basically they're just saying they're going to keep it open. For inactive lines are going to be closed down, which that's fine. If you're not using it at all, they're giving people like 3 months notice to close down an unused line. But if you're using it, keep using it. And it's
to your point, though, it's interesting that this news is on the heels of, I don't know if you caught the story in Axios yesterday, LendUp is going to be shuttering their prime lending business. And then Wells Fargo is like, nope, we're back in.
Yeah, it's Wells Fargo. Yeah, I mean, I think they've
had quite a few years.
They have. I guess. I mean, I mean, in their shoes, it would be not easy to really. They obviously sit around a boardroom thinking, well, this personal line of credit product's not making us anything. Let's just shut it down. Good idea. Let's shut it down.
We should say that about their overdraft fees.
Yeah.
I mean, just think about if the one thing I find interesting. Think if it was reversed and this was a fintech, with all the problems that Wells Fargo's had. I mean, fintech would be destroyed in the media every day. And while banks certainly get their fair share of grief, we don't think we're going to blow up the banking system because Wells Fargo's, a clown show. I think it's interesting that the dynamic that the report on the PPP loans we referenced earlier, the impact it had for a few days and the conversation about fintech, Wells Fargo has done this over and over and over and over again. And the cascading effects on the larger industry is not nearly as potentially damaging as something like the Texas report on fintech.
Right.
It's a higher bar.
Yeah, it is a higher bar, absolutely, because they don't have the FDIC insurance. They don't come with the credibility. They're upstarts. They don't have a track record. I think that, yes, absolutely, one can ruin it for all. But if you think about what Wells Fargo's done, it's actually been a slower drip on some of these consumer products. And where are they going? They're going to neobanks. They have several options, not just Wells. Anybody that's charging an overdraft fee when there's a free bank account that gives you money instead of charges you money because bill pay doesn't align with payday, watch out.
Yeah, for sure.
Okay, so our last story, we're almost out of time, but I want to talk about the Inc. 5000. This is the list of the fastest growing private companies in America. LendIt has been on there in the past. I've been on there in my previous company as well. It's something that has been a badge of honor for many companies, and fintech always seems to to feature strongly. And this it just came out this week. We're talking about fast growth, talking about overdrafts. You've got Dave coming in at number 5, the 5th fastest growing company in the country, 28,972% growth. That's from their revenue in 2017 to their revenue in 2020. And you have to have, I think it's $200,000 of revenue in 2017, and you had to be operating for at least the majority of that year. So it's not like you can just come in and you do a $10 of revenue in 2017, and there are limits. So it's a real metric of fast growing companies. Dave, it's like Chime in many ways, but Dave, what I credit Dave for is really starting this overdraft movement, because they were the ones that really built a business on really the fact that we will not charge you an overdraft fee. In fact, we will loan you first $75, now it's $100. And it's it's interest free, and we'll cover the money for you. So anyway, Dave is number 5. Varo Money, or Varo Bank, now number 7.
That was the surprise.
Yeah, I was surprised about that too,
because forever we've been thinking, all right, Varo's just kind of slow, steady. They're operating under the radar. They're getting the charter, like the first one to do it. And then to see this, it's like, all right, well, Varo's really taking off. You see the commercials all the time with Russell Westbrook. And so clearly Varo's doing some great things.
I wonder if it's their operating costs that have shifted. So for so long, they've been, spending money on having a bank partner and then actually getting the charter and getting through the process. And now they can flip the economics and enjoy the charter. And how many of those accounts that they had on their bank borrowed charter that converted over to their current charter?
That's a good point.
Yeah.
Right. And the fact
they
that
acquired the Simple stuff too, didn't they?
There's BBVA.
Yeah, BBVA. Yeah. So the interesting thing that Chime is not on here, and the only reason Chime is not on this list is because they mustn't have applied.
It's so large. When you get that large, 5 and 10% is
no, but Chime in 2017 was not large, so I think they would have been. They weren't on the list at all. There's 5,000 companies, and they didn't apply. So with Inc., you have to apply. They don't go out and find you. So these are all the companies that applied. And I mean, I think if Chime had applied, I'm guessing they would be in the top 10 as well, given just what's going on. But It had Varo number 5. The next fintech was Greenlight, which has the Visa card for debit card for kids. Then Numerated was spun out of Eastern Bank. Was number 32 as well. We had, as an industry, we had 9 fintech companies in the top 64. So not a bad effort there. Anyway, we are out of time. Would like to thank Lindsay for coming on, being a guest host today. Thanks, Todd. Thank you, the listeners. We will be back same time next week to review what will be another, I'm sure, full week of fintech news. See you later, everybody.
Bye.
Bye. Thanks, Lindsay.
Drop.